Imagine this: DMart reports good number, revenue grows, profit grows, more stores open, the business looks stable, and still the stock does nothing. No rally, no excitement, maybe it even falls. The investors panic. They ask, what is wrong? Are results fake? Is the market blind? Is there manipulation? What if the real answer is much simple and much more painful? What if good results are not enough anymore? If you are a DMart investor, this video can save you from one of the biggest misunderstanding in stock market. Let us start with the truth most people learn late. The market does not reward good numbers. The market rewards number that beat expectation. The difference changes everything. If a weak company suddenly reports strong growth, the stock can explode because nobody expected it. But if a premium company reports solid growth that everybody already expected, the stock may barely move. Why? Because the good news was already priced in the stock price. And DMart is exactly that kind of stock. For years, DMart built a reputation as one of the India's highest quality retail stores. Strong execution, trusted brand, disciplined expansion, clean management, so investors became comfortable paying a premium price for stock. But once a stock becomes premium, life became harder. Now the company must do more than perform. It must outperform expectation every single time. This is where many retail investors get trapped. They see revenue growth and think stock should rise. They see profit growth and think rally should happen. But the market asks deeper question. Was growth faster than expected? Were margins stronger than expected? Was same store growth impressive? Did management signal something exciting for the upcoming future? Did future outlook improve? If the answer is no, then even good number can feel ordinary. Let me give you simple example. If a student expected to score 95 and gets 95, nobody is shocked. But if a student expected to score 60 gets 95, everybody reacts. The market behaves the same way. DMART is already expected to score high marks. So normal success may create zero excitement. Now let us go deeper into what investors should really watch. First, revenue quality. Did sales grow because stores increase or because existing store sold much more? That matters a lot. If old stores are slowing and new stores are doing the heavy lifting, the headline number can look good while the deeper trend weakens. Second, margin. If profits rise, but only because costs were managed tightly, not because demand is stronger, the investor may stay cautious. That is very important. Third, future confidence. Even if this quarter is good, does the market believe next year will be better than this? Stock moves on future belief, not only on present number. And now there is another major issue: competition. Quick commerce is changing customer behavior very fast. People are getting used to groceries arriving in minutes. Convenience is becoming more valuable. That means even strong offline retailer now need to prove they can defend market share, protect basket size, and remain relevant in urban markets. So when DMart reports result, investors are not only reading profit number, they are asking hidden question. Are customers shifting online? Can market maintain pricing power? Will growth slow over time? Does this company need more spending to complete digitally? Can premium valuation still survive? This is why a stock can look boring even when results are good. Now comes the hardest truth. Sometimes the business is doing fine, but the narrative is weakening. Earlier, DMart was seen as the future superstar. If the market now starts seeing it as the mature, slower, but still respectable retailer, then the stock reaction changes completely, very completely. Same company, different narrative, different stock behavior. That is how market works. So what should DMart investor look for now? Important question. Not just good result, look for surprises. Look for stronger same store growth. Look for better margin trend. Look for faster confidence in expansion. Look for signs the company can handle new competition. Look for reason the market may raise expectation again. Without that, even decent result may not enough. Now the final lesson. If demand delivers good result and the stock still does nothing, it does not automatically mean something is wrong. It may simply mean investors expected that already. And when expectations are too high, even success can feel disappointing. That is one of the most brutal truth in investing. So do not ask just a simple question, were results good? Ask the smarter question, were results good enough to surprise the market? That is the question that moves share prices. If you want a real investor level analysis in simple language, subscribe now, like the video because most people watch numbers, smart investor watch expectation. Thank you very much. See you in the next video. Thank you.